All right, let's jump right in. Today we're looking at a pretty fascinating case study, an investor's really unique, time-saving approach to the stock market. It's a whole system built for consistency. And you know what the best part is? It takes about 10 minutes a week.
I mean, this is the big question for so many of us, isn't it? You want to invest, you want to build your wealth, but who has time to be a full-time analyst? The strategy we're about to walk through was created to solve this exact problem.
So the entire philosophy here is built around one simple idea. It's not about trying to find the next big thing or timing the market perfectly. Nope. It's about creating a system, a repeatable process that you can actually stick to no matter how crazy life gets.
And this quote, this is pretty much the mantra for the whole system. Every single part of this is designed to be efficient. It's all about being systematic and smart instead of being glued to your screen all day. It's a total mindset shift, away from constant reacting and towards consistent planned action.
And this is where the rubber meets the road. The investor we're talking about does this just once a week, maybe on a Friday, or over the weekend. By investing when the market is closed, all the emotion just gets stripped away. There's no pressure, no watching the prices bounce around. The order just sits there, ready to go when the market opens. It's simple, disciplined, and honestly, way less stressful.
So, how does this actually play out in practice? Let's get into the real nuts and bolts of the method. This is how the decisions are made, but as you're about to see, it has way less to do with gut feelings and a whole lot more to do with just following a few simple, clever rules.
Okay, so the core idea is this. The system is all about buying stocks that are down, but, and this is the key part, they're from a master list of 20 companies that you already believe in for the long haul. This is a classic contrarian move, buying when things look a bit grim. It means you have to have total faith in that initial list, because you're betting these are good companies that are just temporarily on sale, not companies that are actually failing. The question isn't what to buy, it's which of your pre-approved stocks to buy this week. And the answer is always the same, buy the ones that are struggling.
So, how do they actually find these underperformers? It's a really straightforward three-step process. First, you've got your master list of 20. Then you create two different filters. List A looks back to a recent market dip, let's say April 5th, to find the 10 stocks on your list that have recovered the least. Then list B is simpler. It just finds the 10 worst performers since January 1st of this year.
Now, the thinking behind having these two separate lists is actually pretty smart. They're designed to catch different kinds of weakness. List A, the crisis list, helps you spot solid companies that maybe got unfairly beaten down in a market panic and just haven't bounced back yet. List B, on the other hand, shows you which of your companies are struggling with more recent problems. By looking at both, you get a much more diverse set of potential bargains.
Okay, but here's where it gets really clever and, honestly, super modern. I mean, trying to manually compare those two lists of 10 stocks every single week? That sounds tedious, but this investor uses a simple, free tool that does it all in just a few seconds.
And this is literally the kind of thing they're telling an AI to do. They just take a couple of screenshots of their lists, upload them to something like ChatGPT, and give it this super simple command. It's the perfect way to use AI. Not as some magic crystal ball, but just as a really fast, really efficient assistant to handle a boring task.
And boom, this is what you get back. The AI just spits out this perfectly organized table. In this example, it found 8 stocks that were on both underperformer lists. Then it found 2 that were only on the crisis list, and another 2 that were only on the year-to-date list. And that's it. That becomes the shopping list for the week. Invest $1 in each of these 12 stocks. Total investment, $12. No guesswork, no second guessing.
So, a strategy on paper is one thing, but what about actually doing it? Let's talk about the platform this investor uses, the Bank of Georgia investment app, and look at the real-world good and the bad of putting this system into action.
Okay, the number one reason this whole thing works? Zero, as in $0 commissions. When you're making a dozen tiny trades every single week, fees will absolutely kill your returns. So having a zero commission platform is pretty much a non-negotiable for an approach like this. But, and this is a big but, the platform is far from perfect. The source material points out some real headaches. The interface is apparently pretty clunky, and it takes a ton of clicks just to place one trade. More importantly, it doesn't show you your performance in percentages, only in dollar amounts, which makes it super hard to know how you're really doing. Plus, the transaction history is limited, so looking back at what you've done is a pain. So what do, right? You have a system you like, but the tool you're using is kind of frustrating. Well, you find a workaround. Let's look at the simple but really effective solution this investor came up with to get the data they needed.
And the fix is honestly so simple. You just stop fighting the app, you use a different tool for the thing it's bad at. By using a free portfolio tracker like Google Finance, you can get all the detailed performance data that the brokerage app just doesn't give you.
So here's what that looks like in practice. Once the weekly trades have gone through, the investor just logs into their brokerage account, copies the exact number of shares they bought for each stock, and then just pastes that data into their Google Finance portfolio. Yeah, it's a couple extra minutes of manual work, but it completely solves the tracking problem.
So when you boil it all down, what can we learn from this? Well, there are a few huge takeaways here. First, a disciplined system that you follow week in and week out is way more powerful than just making random emotional bets. Second, don't sleep on simple 3 tools like AI. They can be amazing time savers. Third, you've got to know the weaknesses of your platform and have a plan to deal with them. And maybe the biggest lesson of all is this: a good enough strategy that you actually stick with is a million times better than some perfect strategy that you never get around to starting.
And that's really the question I want to leave you with. It makes you think about what really drives success in the long run. Is it about having the most flawless analysis, or is it just about being relentlessly consistent? Something to chew on. Thanks for joining us for this one.